thank you everyone so much for being here today. Really excited to have this conversation. I think this is going to be a very interesting topic to dive in on, and there's a lot of opportunity to, frankly, show you a lot about what it is that we do here at Kingscrowd and kind of the secret sauce of what I think kind of differentiates us in the market and enables us to do some really, really cool things with our data. So today we're going to be diving in on all things our brand new profitability fund that I think is a first of its kind type of investment vehicle in this new private market landscape. But before we get into that, I just want to give some introductions. As you may or may not know, my name is Chris Lustrino. I'm the founder and CEO of Kingscrowd. We started Kingscrowd about 8 years ago now, as of May 15th, which is pretty cool. And since then have really worked to become the trusted data and investment research provider in the equity crowdfunding landscape. We quite literally track damn near 100% of the Reg CF and Reg A equity and debt markets, which amounts to nearly 11,000 companies or 11,000 raises to date that have occurred over the past decade since the industry was made legal. And we've created quantitative ratings, analytics, investment research tools, advisory tools, all sorts of things for the industry with that. And one of those byproducts is obviously Kingscrowd Capital as well, which is where we're creating a set of diversified investment vehicles to provide, as we call it, kind of one-click diversification into this market by leveraging the value of our proprietary rating algorithm and investment data on each and every one of the businesses that's out there. This is both my kind of passion project, life's work, and the business that I see building into something really, really large over the next decade plus. I love what I do every day, and part of that is because of the wonderful people I get to work with. So before we go any further, would love to introduce Léa and Teddy. Léa, why don't you take it away, give a little background on yourself, and then we'll get into Teddy as well.
Hey, Chris, yes. I joined Kingscrowd back in 2021. Was coming from Stanford StartX, where I was working on admissions over there, working with a lot of amazing founders. And so I joined this Kingscrowd actually before we had Kingscrowd Capital. I've seen all the evolutions of the company, and in the last couple of years, I've looked at about 2,000 deals myself. Done close to about 200 due diligence. And what I love here is that now when I work on a deal, not only Kingscrowd Capital gets to invest in it, our LPs get to get involved in the deals, but we also can share the raise with our age users and just democratizing access to capital is really what passionates me. More specifically, I work a lot on hardware companies with a focus on climate tech as well, but anything hardware really passionates me. And Kingscrowd is a generalist fund, so we just get to touch on every single topic. And what matters is only the quality of the companies and the quality of the founders. Teddy, what about you?
Yeah, I'm Teddy Lyons. I started, oh, can you guys see me? Okay, yeah.
Yep.
So I started my career in a small venture capital firm in Boston called Alchemy Capital, where we funded early stage technology companies. Was there for about 3 years, did a lot of, the classic venture work of due diligence, founder calls, investment committee memos, which has helped me a lot at Kingscrowd as well. But kind of right after that, I worked at a large investment bank, Deutsche Bank, on their software coverage team, working on large equity and debt transactions for software companies and private equity firms. And then, yeah, joined Kingscrowd around the same time as Leia, a little over 4 years ago. I focus primarily, not pri well, my favorite, I should say, my favorite area of companies industry is biotech and early stage pharmaceutical companies. So lead all of those deals for Kingscrowd Capital. But as Leia said, our Outperform fund is a generalist fund. So talk to a lot of founders across, many different industries. But those are sort of my two passions. And yeah, really excited to talk more about the profitability fund here.
Awesome. Thank you, Teddy. Thank you, Léa. They're kind of the brains and the hard work behind everything that we do here. Together, we've made, I think, nearly 70 investments out of our first fund, the Outperform Fund, which we're happy to answer questions about. But we're going to dive in on the Profitability Fund. And just FYI, at the end of this webinar, we will be providing a unique link to sign up for the Profitability Fund. That's going to provide a 25% reduction in management fees over the life of the fund and a 50% reduction in the minimum investment from 10K to 5K. So definitely stick around for that and we'll drop it in the chat. But yeah, let's dive into it. I'm going to share my screen. All right, Let's do this. So, why are we creating the profitability fund? What's the idea behind this? When we look at the venture landscape, right, there are challenges that I think, are all aware of that are fairly obvious, and part of the reason, part of the challenges is also the upside of venture capital, right? Where you have limited liquidity, super long timelines to exit, right? We're 3 years plus into our outperform fund, and like so many of the companies, because they're so early stage, are still early stage, right? They're not IPOing anytime soon. Exits are still far down the road because actually they're finding, in the data that oftentimes venture funds could be going 12 and 15 years to exit and to real liquidity. So it's just a long time horizon because companies are staying private longer, as we've seen over the past 2 decades. That's just the reality of the kind of private to public market path for early stage companies. We also know that venture funds, right, rely on power law outcomes. And again, none of this is bad per se, right? That's, again, part of what makes venture capital venture capital. But when you make it a large part of your overall portfolio, right, your portfolio faces those challenges for long periods of time. So with the power law, right, most of the companies that you're investing in are going to fail or not going to do well when the exit comes along. And so you're kind of relying on a few to do really, really well, and also going to experience a lot of failures along the way, which again is all part of the game. But a lot of people don't want to experience that. We've heard that from many of our investors saying, yeah, I don't love the venture model. I rather invest in things that are making money. And because of that, we started thinking about what could we create for the market that's really unique, and what could we create for the market because of this new landscape that we're in, right? So historically, venture capital is frankly the only source of capital for founders outside of friends and family, maybe some family offices, and then debt, right? So a lot of founders who frankly build really phenomenal businesses, they're raising capital from like SBA loans, right? They're taking out loans. Maybe it's from friends and family, but it may also be from like an SBA lender or just a bank or whatever it may be to kind of continue to fuel their business. But there's really no path for them to raise capital outside of venture capital until you get to a certain size, and then they might start looking at private equity. But the challenge of private equity for most founders is that, when you get, typically it's going to be at least 5 million plus in revenue, and you have to be profitable in order for a private equity firm to look at you. But once you're in that territory, right, like you probably want to continue to run your business, right? Maybe you want to continue to grow it for the next 5, 10 years, but you really need growth capital to continue to see your business scale. But once you hand over the keys to private equity, that's exactly what you're doing. You're handing it over. Private equity nearly always wants a majority stake or a controlling stake in the business. And in addition, they're going to be taking out essentially a really large mortgage on your business to purchase it, because that's what helps them fuel their returns, is putting debt on the business. So once you do those two things, the outcome for a founder becomes a lot less attractive often, especially in the early goings. Once you're ready to retire and sell your business, it certainly can make a lot of sense. But in the early goings or the mid goings, right, you just might not want to do that. So if you don't want to go to private equity because you're not really ready to sell the company essentially, and you don't want to go to venture capital because you're not trying to build a 100 billion or 200 billion or $1 trillion company, you're just trying to build a 50 or 75 or $100 million company, there's really no path for you. And so these deals, these companies, and by the way, there are a ton of profitable, really good companies in the United States that just haven't really had a place to turn other than going out and taking some debt, or, finding a connection in their network that could kind of help them out, right? And so what's so cool about the equity crowdfunding landscape from my perspective is anyone can raise for any reason. And so what that's done is it's opened up the aperture of types of companies that can seek equity capital to grow their business. So yeah, we see tons of traditional venture style deals coming into this market, raising capital to grow their business. They're not profitable. They're early stage. They're trying to, become $1 billion business or whatever it may be. We also see really late stage companies come that have hundreds of millions of dollars in revenue, and maybe they're prepping for an IPO and they want to be able to get more investors on their cap table and set themselves up to go public. And so they're using Reg A. So we see that happen often. And then we see all these companies in the middle that are doing, $1 million, $5 million, $10 million, $50 million, $100 million in revenue and are profitable, and they're just looking to raise a bit more capital to grow for the next 3 to 5 years before they really look for their exit. Whether it's an IPO or selling to private equity or selling to a strategic, they just need a bit more capital to do X, Y, or Z thing so that they can look for an exit in the next handful of years. And that's something that's never been accessible or easy to find in the wild. But because of these marketplaces and because of our data, we can actually do that. So, what we decided to build was the Profitability Fund, where we're going to be looking for companies specifically that when we look at their audited or CPA reviewed financial statements for the past 2 years, what do we want to see? We want to see that they were actually profitable. And by actually profitable, it's let's look at their net income. Is the net income positive, right? Not adjusted net income, which like all these companies will report on, right? But do they actually have dollars, more dollars coming in than going out in any given year? And we want to see that they're growing year over year, right? So we're looking for companies that are showing growth in the business, at least $1 million in annual revenue. I kind of see that as a threshold after having done this for pretty much a decade plus of looking at companies. Getting that first $1 million is very, very challenging, and a lot will just never make it there. Once you kind of get there, you have an established process and a way to sell, and you've figured some things out. And so, from my perspective, the threshold of failure at $1 million, just at $1 million, even if you're burning money, often goes down from those that are prior to that $1 million annual revenue run rate. We're looking for 3 stars or above on our 1 to 5 rating scale. I tell people often that our rating algorithm is not perfect, nor is any rating algorithm or scoring system out there ever going to be perfect. But what I would say is if you look at our companies with a 3.0 or above rating, pretty much all of them you go like, yeah, that's interesting. That's a fundamentally sound company. I don't know if they're going to be wildly successful or not, but it's fundamentally sound. It looks like of a decent quality, right? And if you look at the companies below that, oftentimes either there'll be real fundamental issues where you go like, whoa, there's a lack of quality there, or the risk level is just extremely high, right? Like, sure, they could become worth $1 trillion, but they have to raise $200 million to get there and have like a 15-year runway to get there. And there's an incredible amount of risk and their burn rate is insane, so on and so forth, right? So with our profitability fund checklist, what we're really trying to do is create an investment vehicle that comes with dramatically lower risk, right? These companies are profitable. So we don't really expect any of these businesses to go out of business. It certainly could happen, but we don't expect that very many, if any, will go out of business. We're looking for companies that are valued in the 7.5x rev multiple or lower in terms of their valuation. So if you're doing $1 million, right, we would be looking for a $7.5 million valuation or below. So we're looking for reasonably priced businesses that can provide upside from where they are today. We want to know from the founder, sometimes we've literally talked to founders to say, we kind of are like we're profitable by accident, but like that's not what we're trying to do, right? We're trying to grow aggressively. We're not looking for those businesses. We want to find businesses that want to remain profitable and are trying to exit in the next handful of years. And we'll be looking to make about 25 to 30 investments here. So ultimately, what are we trying to do? We're trying to invest in 25 to 30 profitable, fundamentally sound businesses that are well rated by the Kingscrowd rating algorithm that we think are well valued that can all exit in the next 3 to 5 years. So in reality, right, if you think 3 to 5, it's probably more like 5 to 8 because things always take longer than you think, with very few failures. And the hope, again, there's no guarantees with any of this, and these are all projections, right, in our thesis, but most companies will exit anywhere between like a 1x to a 5 to 7x. If you look at the median return of a traditional venture fund, it's actually about a 3x on a fund. So it's like, can we deliver around a 3x or maybe a little bit above, like a traditional venture fund with lower risk on a shorter time horizon, which would actually increase your IRR? Again, this is the thesis. This is our first time that we're running a profitability fund. So I'm not guaranteeing any of you this, but I'm saying this is what we're trying to pursue and build. And we believe by doing this, we're providing another type of investment vehicle with a very different risk profile to help you continue to build a diversified portfolio in this market. And we really think we're kind of a pioneer of building a fund like this because even a private equity fund, while they're investing in profitable businesses, that is absolutely true. They're essentially taking them over and then running them non-profitably for the next handful of years, not because they've fundamentally changed the business, but because they took out a huge mortgage and are using the profits to pay down that mortgage on the business, right? So it immediately takes on more risk once the fund takes it over and they have all that debt sunk into it. Versus us, we're taking passive equity investments in profitable businesses that are not taking on more debt capital. So from my perspective, it's a really healthy way of building, again, a far lower risk investment vehicle. So that's what we're trying to do here at Kingscrowd. And again, why are we able to do this? Because we quite literally track the entire Reg CF and Reg A markets where we have real financial statements for the past 2 years for every business raising in this space. And then on top of that, because there's 2,000 or nearly 2,000 plus companies raising under Reg CF and Reg A year, just by matter of there being that many companies raising, you can identify these companies in the wild, right, through our automated rating algorithm. And so that really enables us to build something that I think would be very hard to replicate elsewhere. So that's a little bit about the fund. I already kind of hit on all of this where, kind of our portfolio construction and strategy. So what I want to do now is I want to turn it over to Léa and Teddy to go through a couple of kind of sample companies to give you a better sense of what all this looks like when we're actually looking at a real company. Léa, you want to go first?
Let me go. Thank you, Chris.
Thank you.
Um, Everybody can see my screen.
It is coming on up. Let's give it another second.
Come on. It wouldn't be a real webinar if I would not be asking this question. Okay. All right.
There we go.
Awesome. Let's start with the very first case study. So here we just want to kind of provide you with an idea of the type of companies that we want to invest in. So a very good company that could have been a target if we would have started that fund a couple of years ago would have been Drink Element. Just a quick overview for those who have never heard of Drink Element. It's electrolyte company. So they provide drinks that have high levels of sodium, potassium, magnesium, and what that gives to the customers is hydration, energy, and performance. And they're really kind of marketing their product as zero sugar, clean ingredient company. And well, they kind of started by targeting active customers, athletes, people that like exercising. They kind of expanded as an everyday hydration company to make sure that anybody that is kind of wellness, of health conscious, stays hydrated. And the way they did that is that they have multiple product line, as you can see on this line. So they have ready to drink cans. They have also kind of electrolytes packs that you can just add to whatever you're drinking. And what is very interesting with this company is that they are in 5,000 retail locations. They have partners like Target, Walmart, and they already kind of are selling well enough and they have enough traction that for us as VCs is very interesting, and we kind of already get a hint of where they can get. So let's show you now what happened when they first started raising. So it was back in 2021. They had a valuation of $60 million and a revenue of 12.5 million. So we're definitely within that range of more than $1 million in revenue and less than 7.5x in terms of revenue multiple. And they were profitable if or anybody, maybe one of you actually invested in that company back in 2021, thanks to Kingscrowd. If you would have invested in that company, well, back in 2023, revenue jumped from 12.5 million to $206 million with a positive net income of $41 million, which is basically a 20.3 net profit margin. And kind of the valuation of that company also grew obviously according to that. So what we've been able to see is that, companies like that that are good fit for the profitable fund can actually grow well. And we just had the right signals in 2021 that were telling us what will be happening. So this is for the very first case. And what's good with what Teddy is about to show the second case that we actually invested in the company with the outperform fund. So Teddy, up to you.
Yes, thank you, Leia. Let me. Okay, everyone see this? Lovely. All right, so yeah, so want to kind of walk through this next case study, ConsumerDirect. I think really captures kind of exactly why we built this fund the way we did. So ConsumerDirect, they build AI-enhanced financial tools that basically help everyday customers understand and improve their credit, their borrowing, and overall financial outcomes. So they have products like Smart Credit and a proprietary AI engine called Max AI that analyzes deep financial data to give people personalized credit insights. The business model is they really scale through a B2B to C model. So they have thousands of active distribution partners pushing their tools out, which drives recurring revenue. They have 300,000, over 300,000 active monthly subscribers, and as mentioned, 3,800 active distribution partners. So kind of this is why it's sort of a perfect fit for the profitability fund is when we first looked at them in 2024, which is, as Leah said, when we invested in it through the Outperform Fund. They were already doing about 70 million in revenue, $71 million in revenue. They were profitable, operating at an 88% gross margin. So this was not a company that was burning cash and, hoping to grow into a story. It was a real profitable business, raising growth capital through equity crowdfunding. And something to note is Consumer Direct, before they came to equity crowdfunding, they had never actually raised outside funding. This was a completely bootstrapped business. So just really, really impressive company. And if we look at what happened just a year later, they came in at a $500 million valuation, um, and about a 3.3x move in roughly a year. So they also raised revenue to 93.2 million, still profitable, still running at the high 87% gross margins. And importantly, they're going to be soon preparing for a public listing, TBD when that exactly will be, but a really great profitable company that I think will do really well in the public markets. And obviously, IPOs are a liquidity path that we really care about and we'll be looking for companies that we invest in through the profitability fund. So I think the sort of takeaway on this one is, we don't need, as Chris mentioned, we don't need a kind of power law miracle here of, one company returning the fund and more. This is a profitable company, strong fundamentals, reasonable entry price, and you can clearly kind of see the value creation and revenue growth that followed. So I think it really sort of condenses the thesis of the fund really nicely. If you look at a company like Consumer Direct. So I think kind of something else to sort of look at here are so those two case studies, those were two kind of older companies that we saw, Consumer Direct a little more recent, but these are some opportunities that are either on the market right now, live, or recently had a closed round. So companies that we could have invested into from the profitability fund. So these are real companies that have come across our desk within the last 6 months, and each one fits those criterias that Chris sort of walked through. So three quick examples. So Nine Line, an apparel company, they earned a 4.9 rating on the Kingscrowd rating algorithm, nearly $40 million in revenue, over 4.2 million in net income. So sizable, profitable business, and the valuation of just 47.2 million, so just 1.2x revenue multiple. So for a profitable company at this scale, that's obviously a very solid entry point. Secondly, the bouquet company, flower and gifting brand. So the largest revenue here, of 90.3 million, profitable, $5.1 million in net income, priced at just under $200 million. So just about 2.2x revenue multiple. So profitable brand at the scale and multiple, that is exactly the type of company our filters and our checklist would be built to identify. And then lastly, Purity Coffee, health-focused coffee brand, a bit smaller at $24 million in revenue, but obviously still substantial. Profitable, around 355K in net income, which is a little bit on the lower side than we'd like to see in net income, but that's a company that, could very much grow that bottom line in the coming years, especially with some more growth capital that they'd be getting from equity crowdfunding. So yeah, point of showing these three, this thesis is not, theoretical. It is, it's happening right now in the market. We're seeing companies like this raise. Every month we see companies that will fit the criteria. And because we're deploying into just 25 to 30 companies, we can take larger positions in a smaller number of companies because of the lower risk profile of each one. And as Chris mentioned, we really think we can get to that median venture return with materially lower risk. So that's really the thesis here. This is the companies that we're seeing now. There's many more, but just wanted to highlight these three. So yeah, really, really excited about this fund and kind of getting it closed and so we can start deploying. And Leia, we want to talk to this.
Yeah, let's go through the fund economics and structure. So, in terms of how much money we're raising, we're going to be raising up to 5 million. This is kind of the ceiling. But sometimes you can have a little bit less and then start deploying. Chris, is that something you want to kind of
Sure. Yeah,
jump on?
absolutely. So AngelList essentially says how much do you want to raise, right? And once it's set, you can't go back and change it. So we're allowing up to 5 million. My goal really for this first fund, recognized as a debut fund, it's a beta fund with a brand new investment strategy we've never tried before, is really somewhere between $1 to $2 million is the goal in this fund. So far, we have about $500,000 circled. My goal in the next 4 weeks is to get it somewhere between 750 to a million, and then I know some checks will kind of trickle in throughout the end of the year and can continue to trickle in, for a while. So all of that is to say is our goal is really get to somewhere around 750 to a million over the next 4 weeks and start deploying by midsummer.
Yeah, what we've seen with our first fund is that when we're actually starting deploying money, we had a lot of people that were kind of on the fence and started to invest in the fund. So we're expecting the same thing to happen here. In terms of minimum investment, so $10,000. However, sometimes we may provide, a little discounts or just a little ability to start a little bit earlier as well at a lower interest point, but kind of 10,000 is kind of the baseline. In terms of management fees, so this is a very, very reasonable management fee of 1% plus engine list admin fee. So I'm just adding a couple dots, something
Yeah, and just to give
right
a
here.
range, basically they say it'll be between 0.2 to 0.4% based on dollars raised. So again, in looking to raise between 1 to 2 million, I'd say it's going to end up just somewhere about 0.3% per year. So 1.3 traditional fund, right, is a 2% management fee per year. So we brought that down by just about 50%, including the AngelList admin fees.
Definitely. And one more thing, carry as well, right? Very reasonable compared to traditional VC. So 5% for us, 20% for traditional VC. We really want this. We've been working with customers, LPs for, as you said, Chris, 8 years now. And democratizing access to startup investment is also democratizing access to VC. And that goes through having carry that are just reasonable and really helping LPs out. So this is a passive structure, really optimized for LP outcomes. And I see we have already a question. So maybe Chris, you want to take it. And if anybody has questions, please drop them in the chat. We're more than happy. It's the time to answer them right now.
Sure. So first up, I just want to drop in here. I'm going to drop in the chat our special link. This lasts until Friday. Well, it'll be like 11:59 p.m. on Thursday. And this link is only for folks who are here on the webinar. So the minimum investment we're cutting in half. So instead of getting in at 10K, you get in at 5K. So if 10 is high for you, this is your opportunity to get in at 5. And then we're reducing the fees by 25%. So basically, it's going to be a 3.75% carry instead of 5%, and it'll be a 0.75% annual management fee. The idea behind the fee structure, just to give you a little bit more of a sense of why we position it there, is we believe by having automated deal flow, right? We don't have to go and source any of these deals. They already exist. They're in the ether. They're on Dealmaker. They're on Republic. They're on WeFunder. They're on Start Engine. We don't have to go find the deals. And then our data drives 70 to 80% of the decision making, right? Through our rating algorithm, we identify these deals automatically into our kind of, deal explorer that you could use on the Kingscrowd website. So the idea is we're very much kind of Robin Hoodizing, right, the private equity and venture space, where because we have automated deal flow and data that drives the decision making, we could dramatically bring down costs for investors and increase performance for investors in doing so. So I think it's super powerful, and it's a part of what we're about here at Kingscrowd is democratizing access to better investment opportunities at a lower cost by creating data technology, right? So it's very core to who we are and what we're about. I'm more than happy to get into questions here. So do please start dropping them into the chat. But before we actually hit on the questions, Leah, Teddy, I would love to just dive a little bit further. We've been running the Outperform Fund, and we're going to be running this fund in the same way in terms of our due diligence process. Can you talk a little bit about what that process all looks like?
Yeah. Yeah, I can shed some light on that. So it really starts with coverage. So as Chris said, we screen every company that files a Reg CF and Reg A round. That is sort of top of funnel. It's wide on purpose. From there, we run each company through the rating algorithm and through the filters to kind of narrow down the universe of companies we can select from. So for the profitability fund, as we kind of went through in the slides, we're gonna that those filters that we'll be kind of paring the list down to will be companies, yeah, positive net income in the last 2 fiscal years, $1 million in annual revenue multiple under 7.5, 3 star or higher. Kind of we went through all of that. Um, so what we've been doing for the Outperform Fund, which is a bit of a different thesis, those companies that we invested into for the Outperform Fund leaned a bit more towards high growth potential, kind of more traditional venture-like returns, um, or kind of growth categories, I would say, than this profitability fund. But the kind of discipline of the screen is very similar. But anyway, once a company passes the filters, we dig deeper into that smaller pool of companies, figure out which ones we genuinely want to talk to, schedule a call with the founder. After that call, Leia or I will write an internal investment committee memo, real deal memo that we'll present to internally to the investment committee, of course, will push back the last questions, and Layer I will answer anything we can during that meeting. And then for anything we cannot answer on the spot, we'll go back to the founder either over email or on a follow-up call, and we'll kind of get that answer and answer those questions before we move forward. And then, kind of once that process is fully complete, the committee will vote anonymously. And I think that anonymity really matters because it kind of keeps the decision honest and free from any one person's influence. And yeah, so really, by the time we make an investment, the company has gone through, widescreen, focused filter, founder conversation, deal memo, investment committee, and then kind of lastly that anonymous vote. So there really is sort of a nice diligence system behind every name that we've invested into in the Outperform Fund, and that we'll invest in the future in the Profitability Fund.
And what I like about the vote, and thank you, Teddy, for that, is that when we have the vote, one, everyone's vote counts the same. But what we do is it's actually a quantitative vote too. So you vote anonymously, yes, no, and then there's a bullish, bearish rating scale. Like how bullish are you on your decision, right? So you could be a yes three, a yes one, like I'm saying yes, but I'm like not 100% there. You could be a yes five that's like please, for the love of God, let's make this investment, right? This is an amazing company. And so we actually have it kind of weighted as well. So if we have four people who make the investment decisions. Brian Belay, our CTO, is also part of the investment decision team. He's made over 200 plus investments outside of Kingscrowd over the past decade. So also a very experienced investor in the market. So it'll be, if there's 2-2, we'll look at what's weighted higher. Are the no's more bullish on saying no, like I definitely don't think we should, or the yes is more bullish on saying yes and thinking we should. So we really use data at every layer of the process. And what I think is cool is like, you could, if you're not accredited, you will be able to follow our investment strategy on Kingscrowd. So A, we'll be putting out deal memos for each of the investments we make under the profitability fund. And B, you could also use the same filters of profitable, a million plus in revenue, rev multiple of 7.5x or less, so on and so forth, to be able to try and follow the investment strategy as well. So there are ways to do it if you're not accredited. But it's all very disciplined and very, very data driven, which I think is awesome. Again, it goes to our kind of core identity of what we're all about. But layering on to the data piece, Leah, I'd love to hear from you. You've talked with hundreds of founders that we've diligenced over the past several years. Talk to me a little bit about, when you actually talk to that founder, some of the things that stick out in that process where you feel really convicted in that person and really excites you.
Yeah, the founder call is my favorite part of the process because when you invest in equity crowdfunding, the only thing you can do is kind of ask questions on the Q&A and then it's public. Founders may or may not answer you. They may or may not be very transparent. So we really have the opportunity with the fund to get founders time because they know if they give us their time, that we're going to be able to spread the word with just hundreds, thousands of investors and they can get returns. So what I really get out of these calls is that I just try to establish, kind of a trust relationship with them. And there's so many times where they tell me things like, I shouldn't be telling you this, but don't repeat that, but, and I don't repeat it. But that influences my investment decision. And so is this not information that you're going to have on the report, but you know that when we make an investment, we may have access to some things that we would not have heard about otherwise. So um, I want to say maybe best case scenario for me is when I talk to a founder and the passion just comes through. And you know that this person is going to be working on this company no matter what. And at the contrary, sometimes you're talking to a founder and you just can feel that they're exhausted. You can feel that they may just drop the ball very soon. And there's some red flags that can come out of calls as well. And so this is maybe one of the most important part of the due diligence process is to be able to ask the questions that are needed. And I don't really let founders go through the pitch deck because it's just the same thing every time. I make sure that my questions are being answered so I can serve better the interest of Kingscrowd.
I love that. Thanks, Leigh. I appreciate that. I couldn't agree with you more. One other layer is pretty much nearly every founder we invest in, and frankly, a lot of them that we screen once they're kind of in the process, not like a wide screen, but the narrow screen we have of people that fit our profile. I'll have on my podcast, Inside Startup Investing, and it is. I agree. It could be very illuminating. Like, you're looking at the facts, you're looking at the data, you're going through it, but then I get on a call and I'm like, I've been convinced. Okay, now I see the bigger picture. I see what it is that you're trying to do. Or the founder is like deeply compelling in a way where you go like, oh wow, like if someone's gonna figure this out, right? That'll like if someone's gonna figure it out, this is gonna be the person that figures it out. Like sometimes when there's that feeling of boy, there's a lot of risk in this one, like this is such a hard problem they're trying to solve. But then you talk to that person and your conviction in them, you go like, okay, someone's gonna figure this out. I think a great example wouldn't fit this fund, but a year ago we invested in Siren Biotechnology, which is like a brain cancer biotech company, early stage company, and it's like there's so much risk in that, right? They have three trial layers they're going to have to make it through to prove that like this works, and it very well may not. But boy, when I talked with the founder, she left her career as a professor for 17 plus years because in 17 years of doing research, she had never seen more compelling data than what she saw for Siren Biotech. And like when you hear that, you go like, holy cow, for someone to spend nearly 2 decades just researching potential, drugs, right? From like a ability to solve the disease. And she looks at that data and goes, this is better than any data I've ever seen. And I will put my whole career behind to do this. You're like, okay, there must really be something there, right? It gives you a lot of conviction in that person. So this process of multiple of us speaking with them, diving in, asking the questions. And frankly, I think another thing that always sticks out to me is like those who are willing to give a high level of transparency versus those who are not. When I get, like 4 pages of answers back on like 3 or 4 questions, I'm like, this person probably is not messing around. Like they'll send us models and this, that, and the other thing because they want to be transparent and real with us about, whatever question it is that we're asking. So we really do a deep dive on these businesses. As part of our due diligence process. So we're going through a multitude of layers. And I would argue just going through the process of getting audited financials and listing a Reg CF in the public, discourse or realm, I think speaks to the fact that these are companies that are willing to go through the rigor of the process. And that gives me a lot more confidence in those investment decisions. So I like to think we have a very bolstered process here and one that can really drive long-term results. Time will certainly tell, but we're pretty excited about what we're building. Want to get to a couple of questions that are here. So with low multiples, does it mean that certain sectors are not being considered? So Jeff, great question. I would say it's not that we're not looking at certain sectors, but I would argue, yeah, probably most likely something like biotech we're not going to look at, right? Because the screen is not by industry, it's by are they profitable? Do they at least have $1 million in revenue, so on and so forth, right? So biotech is probably not going to be there. I'm sure a lot of these AI companies today are not going to be in there. If you're looking for that, you should certainly invest in our outperform fund or future outperform funds. But this is much more looking at like, I started my career in traditional private equity, looking at like those mid-market private equity style deals, right? Cash flowing, predictable revenues, know how to grow the business, been around for a while, looking for a near-term exit. So very different profile. So I would argue those profiles will very likely lead to far less AI investments, far less, biotech investments, and other things like deep tech that require tons and tons of upfront investment, unless they're already very well-established businesses. All right. Next question. I would have a legal question. What would happen in the case Kingscrowd will be dissolved or goes out of business? Great question, and very hopefully that doesn't happen. But I think it's fair to ask the question. If that were to happen, Kingscrowd Capital LLC is basically like a fund administrator. And I may be using the wrong technical legal terms, but it is its own entity. Those dollars are set aside for our LPs to invest out of the fund and invest on their behalf. If Kingscrowd was to go out of business for some reason, at that point, basically the investments that are in there would continue to vest. And I believe at that point, if we were no longer going to run the fund, I have a feeling someone would actually want to continue to run the fund and probably kind of carve that off. So I think regardless, probably nothing would change at all. But say everything was gone tomorrow, right? And I would say basically whatever cash is still in there would be returned at that point. We would say, hey, we're shutting it down. Please return all cash to investors. And then the investments would continue to hold until the end of the hold period. That I think is pretty much what would happen in the process. Because again, it's not an asset of Kingscrowd. It's not. It's your money. It's the fund's money. We're investing out of that fund for the very specific purpose of the fund. So kind of continue to live as its own thing and dissolve it as needed. But again, when in dissolving, it would be cash to you and eventually those equity holdings to you as well. Again, hopefully that doesn't happen, but good question. If you want to follow up with more details, I could certainly reach out to the AngelList team to say, has this ever happened? What does it look like? What exactly is the process? We certainly could try and answer that for you if you'd like. And then what is the average hold time for a 3x to 5x ROI? Again, I would say with the style of company we're looking for established growing businesses with at least $1 million in revenue. And I think often they'll be far more than that. All of these companies, we're looking for 3 to 5 years, which again, if you're thinking 3 to 5 years, and it probably averages 5 to 8 years, but it's somewhere like 5 is probably the median, right? Of what we're looking to achieve is like within 5 years, they exit. No guarantees, but I would say that's like generally the hope and goal of what we're looking for. All right, can open up the Q&As here. With profitable companies, I expect the likelihood of potentially going public may happen more often. How do you treat companies that go public? Do you hold, sell at IPO, distribute shares, or what? Great question. Very much a case-by-case basis. We're actually trying to put some parameters in place right now. So we do see this epidemic of companies that are far too young and not at all prepared to go public, going public via microcap IPOs. And I would say this is any IPO in the range of like $50 million valuation or less. Often these companies at best have hundreds of thousands of dollars in revenue. And when they do that, they often tank very quickly. They'll maybe have a 1 or 2 day spike. And then as people are able to get their shares into their brokerage account or wherever to trade it, we see a dramatic drop in the price, which again is more a fundamental issue of the types of companies that are deciding to do that are not ready. I would argue if a ConsumerDirect goes public, it's probably, at worst going to just kind of remain flat and at best, starts to go up nicely. So in that event, we're going to, consider and look at our goal with everyone is make sure we have our shares available to sell if needed as quickly as possible. And then from there, kind of have a plan of, okay, hopefully most of these companies will at least be flat at IPO and not to the price that we got in at it, but whatever their IPO is. If that's a really, really nice multiple for investors and we say, hey, we just got a 10x in, 2 or 3 years. Okay, great. Let's sell and move on. We certainly can do that. Or we could say, hey, let's sell our principal and let the less ride, right? We can make those decisions at that juncture. Like I said, we're trying to put parameters in of what that looks like based on different scenarios, but it'll be very scenario driven. We will not be distributing shares. It'll remain with Kingscrowd Capital until we sell. Once we sell, then the cash will be automatically distributed to investors. So as soon as we make a sale, It's not reinvested into the fund again. We automatically pro rata will provide that back to investors at that time. I know that's not a perfect answer. It's very dependent on how the IPO goes, where that company is at. There's a company that I've looked at in the past that, again, I won't provide more details, but I happen to know they're prepping for an IPO with one of the largest investment banks in the world. And like when they IPO, it's probably going to do quite well, right? And in that case, like, hey, maybe you do hold for a few quarters, but you kind of continue to monitor the situation once they IPO. Um, if the opportunity rises, will you source any potential profitable deals from secondary markets? A Reg CF or Reg A company that previously raised online but might have shares available at a good deal discount on the secondary markets or via private Reg D, such as in a follow-on? That's a great question. I would say for the most part, it's unlikely to be secondary shares at this time. I could actually see a world where we do that in the future. We actually create a secondary fund to find companies that are low priced on the secondary market and purchase up those shares if we feel as though it's a good deal. But we probably won't do it out of this fund. Now, in terms of follow-ons, if say for instance we have invested in a Reg CF deal that is then doing a follow-on round offline, and maybe it's a deal we did out of the Outperform fund, and now they're profitable and growing and look at exit in the timeline and all of that stuff. What we do on those occasions, yes, in those instances, we will say, okay, provide us all the data on the deal and all your financial statements. And if they could provide us everything we need and we run it through the algorithm and it still meets all of our criteria, then yes, we can consider investing offline. In those cases, we would. We wouldn't look to just like go find deals in the wild. Again, the idea here is really to utilize the marketplaces, right, to find this automated deal flow and have all of the exact same rigor and structures in place for each and every deal. So that's that. Why is Kingscrowd uniquely positioned to be able to offer this type of fund? Like, why haven't other VCs done something like this in the past? There is a slew of reasons for this. First off, every venture capital firm is looking to do the same thing, invest in big ideas that could become worth billions or hundreds of billions, or in this day and age, trillions of dollars. So they're looking for power law returns. They are looking to invest in companies that they think could 1,000x, 10,000x, all of this kind of stuff. And return funds with one investment and have the rest of them fail because they were just backing big ideas, not necessarily good businesses. So they are in the power law game. That's what they're trying to do. That is the purpose of a venture capitalist in pretty much every situation. The other challenge for them is that trying to source profitable deals in the wild, again, venture capital has pretty much created the perception that I think is reality of we only want to invest in companies that are early stage or growth stage, burning tons of money, need lots of money for a really, really big idea. And so profitable businesses, if we're looking at some of the businesses that we had pulled up, like Nine Line Apparel, right? They're an apparel company. Like every VC is not even going to take the intro call with them. So they're never even going to have a chance to pitch them. But it's not because Nine Line isn't a good company. It's most likely better than 90% of the companies they're investing in. It's because it doesn't fit the strategy. The venture strategy is very specific. So profitable companies aren't seeking out a venture capitalist. So they're not going to find them, certainly not at scale, right? The real power of us is that we see thousands of deals a year, all in an automated fashion with real financial statements for each and every business coming in the door, created by a third-party CPA. So we know it's real and verified net income. It's not BS. It's not pinned up by the founder with some, special adjusted whatever. So that's the power, is that we can find them in the wild because we have this automated data and deal system. So hopefully that answers that question. Will my profitability fund investment be viewable in my Kingscrowd portfolio? What types of updates can I expect to get on the status of my investment? Great question. First off, yes, you will get access to a special portfolio we create where you'll be able to access the profitability fund specifically directly in your account and see the investments we add. We send out a quarterly update on all of the investments we're making. And if we have any news of companies that have that we've invested in, we will share that with you. We do reach out at least once a year to also try and push on the founders to provide us some sort of update if they don't. And we will provide as many updates as we can. Unfortunately, some people do go dormant in terms of providing updates, and that's a challenge and something that we try and work through as much as we can. But it is something that comes up, where some of the investments will not be totally transparent with us. But we work to get as many updates as we possibly can to you. And you will at least get a quarterly update of latest investments made and any kind of word on the street of the companies that we've invested in. To my understanding, is it necessary to be an accredited investor? The answer is yes. This is an accredited investor product only. Unfortunately, it's damn near impossible to create a non-accredited venture fund. There are ways of doing it that cost millions of dollars and are deeply complex. It's something I would love to do. We're certainly not in the state to do it today. Frankly, I just prefer to see the rules change where everyone can invest in venture funds and it is legal to do so as a non-accredited investor, but that's not the structures that be today. So we can't unfortunately provide that. As a reminder, we have our special going on right now for attendees only. So I'm going to redrop the link in here for you. This is going to reduce the minimum investment from 10K to 5K for the next 2 days. So between Tuesday and Thursday, you can invest 5K minimum instead of 10, and the management fees are reduced by 25%. They're already very low, but now it's going to be a 0.75% annual management fee and a 0.75% 0.75% annual management fee and a 3.75% carry. Any other questions from the crowd? All right, not seeing any other questions. Léa, Teddy, any last words here?
No, I think we're good. Excited to start diligencing companies for this fund. It's, as we said, we've been working on the Outperform fund for a few years now, and that's been great. But kind of, it's even more exciting to launch a new fund thesis and kind of structure these deal memos differently. So yeah, just a lot of excitement here, and we've been doing this for quite a long time, and excited to continue.
Yeah, we've seen this type of company just raise well, perform well, succeed, and I'm thinking of ConsumerDirect that Teddy just talked about right before is the typical company we want to invest in. We've seen these deals, and actually kind of lowering the rating bar is also a good thing for investors because we're going to be able to target really profitability, even if sometimes one or the two metrics are just not perfect.
Awesome. Thank you. And as a reminder, we have just about $500,000 circled in the fund, looking to raise the next 250 to 500K over the next 4 to 6 weeks. And then the goal is to start investing and deploying out of the fund by midsummer. And also for those who have never used AngelList, the way it works is you could actually make 50% of your investment today and 50% at the first capital call, which will be in just about 2 years. So say you want to invest 20K, you could actually just put in 10 today and then wait until we make a capital call, which again, I'm letting you know today, will be about 2 years from now, about halfway through the investment cycle of the fund. So if you're feeling like you want to invest more and you're like, I don't have 20K today, but I do have 10, then you can commit 20 knowing that you'll have the 10 in 2 years from now. Super excited about this. I think we're doing something very, very unique in the market. Just another representation of how powerful A, the equity crowdfunding marketplace can be, and B, how powerful our data can be to enable this. Would love to have you along for the ride. I think it's going to be really, really interesting as an investment vehicle for investors. Hopefully we could prove some really nice returns on this first profitability fund and continue to launch more in the future. And provide you a really unique way of getting one-click diversification into profitable businesses. So thank you everyone for joining us. Thank you for those of you who are already investors in Kingscrowd the business, which right now is raising on Start Engine. If you're interested, you go check out the special perks we have. If you invest like 25 or 50K in the business, we have additional things to offer you in terms of management fee discounts. But really, really glad to have you all here today. Thanks for the wonderful questions. Thanks for your time, and look forward to seeing you on future webinars about all things Kingscrowd. Have a wonderful day and see you all soon.